What should you look for in a high cash value life insurance policy? If you are considering a whole life insurance product, how can you be certain that that policy is designed for maximum cash value? And how can we be certain that we don't have buyer's remorse after we purchase that product? This happens so much in the insurance industry where someone purchases a policy. They're told it is designed to the absolute best possible degree, maximum cash value. They buy it, and then a year later they see a better option with the same company and same product, just with stronger cash values. That's where buyer's remorse comes into play. So we're going to go through step by step exactly what to look for here. Number one, if a policy is set up properly, the core benefits specifically around the cash value are as follows. It is a safe, liquid, tax-free area to position money. Safe, meaning your money is not invested in the stock market at all. We have a guaranteed floor, dividends on top of that. The net internal rate of return on a well-designed policy in today's low interest rate environment will likely fall somewhere between 3 to 5%. That's the net performance at the end of the day, not a gross rate. Liquid, you have access to your money anytime. And then tax-free. Tax-free now in respect to you accessing the cash value, and tax-free later if we want to take retirement income from the product. And then also the death benefit. Death benefit proceeds are always paid out 100% income tax-free. Now there's a lot more to these core benefits, especially the tax-free part. There are instances where we can mess a policy up and the cash value is no longer tax-free. We've got other videos on that around the core benefits of a whole life insurance product. Here's what the policy should look like. Here's what I should look for if I am a policyholder, a consumer considering this product. Number one, I make a payment. 85 to 90% of my payment is in cash value in the first year, if I'm max funding it. I'll explain what that means in a little bit. Number two, break even or positive cash value falls somewhere between years 3 and 5. So what this would mean, if I am paying in $10,000 per year, $10,000 per year over 5 years is what? $50,000. That means if I have a break-even point of year 5, I should have at least $50,000 by year 5. I'll see that with most traditional whole life insurance products, and some products will credit a break-even point earlier than year 5. Between 3 to 5 is a good range to look at, assuming I'm max funding it. And then flexibility, being able to adjust your payments, meaning the amount, the time period. This is so important, because so often one hears about a whole life insurance product and thinks, I have to make premium payments for my whole life. And that's not the case at all if it's designed properly. So we can design a policy where we can have a minimal premium. Take, for example, you want the ability to pay in $10,000 per year, but you don't want to get a bill for $10,000 per year. You can set it up where you can easily commit to $1,000 per year, and then at discretion add up to $10,000 per year. Now you have flexibility in how much you pay into the policy each year. Perhaps you plan to pay into it up until age 65, but life happens and you want to stop after 5 years. You can do that kind of stuff if we design the policy properly. Very powerful in that respect. Now, on that same point with the flexibility in funding, that has to do with the 85 to 90% upfront as well, or I should say it has a relationship to it. Meaning, if I pay in $10,000 and that's my maximum amount each year, I'll see that 85 to 90% upfront. If I have a $1,000 minimum and I only pay the $1,000 minimum, I won't see 85 to 90% of that show up front. We're going to look at an example on this at the end of this video too to help clarify that point. Last point, company selection. There are a lot of insurance companies out there, which you do not need me to tell you that. You don't need anyone. We could just turn the TV on or YouTube and an ad will pop up. Among different insurance carriers, you have the 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. When you look at those companies, we've seen one consistency here. They have consistently delivered among the strongest internal rates of return, strongest actual cash values to policyholders. And what I always like to specify here is I'm not referring to illustrations, projected values. We're talking about real policies that have lived the test of time. And when we work with banks, corporations, and the ultra wealthy, they're using these companies because of their safety ratings, because of their financial strength, but most importantly, because of a track record of actually delivering on their policies, strong cash values over time. Let's look at a quick example here. So we're going to look at a 40-year-old male paying in $100,000 per year for 10 years, a total of $1 million. The first example we see is a 100% base premium example. I'll often refer to this as a great example of what not to do if your main focus is cash accumulation. The reason why, he pays in $100,000, and what do you see in cash value right off the bat? Next to nothing. To be precise, $3,300 in cash value. Not that attractive. He pays a total of $1 million in over 10 years. What's highlighted in yellow here represents his break-even point. By year 11, he has his $1 million back. Long time to get his money back. Compared to the example next to it. Same policy here, same company, same individual, same out-of-pocket, everything's the same except for that policy design. So here, he has a minimum premium payment of 10%. So approximately $10,000 is directed toward the insurance premium, the underlying base premium and the term rider, those two combined. It's about $10K. The rest is going toward riders that accelerate the cash value. As a result, where we mentioned it should fall between 85 and 90% right off the bat, there we go, 88% initially. Now some products do credit between 90 to 95%. That's called a high early cash value product, which are attractive to some. It's a good option to look at, and we've got other content on that. But going back to the policy design, what should I look for with a traditional product designed for long-term performance? Year one, 88%, between 85 and 90. Breaking even between years 3 and 5. Here we go. And then if I look at the year 10 value, this is what's so fascinating to me. Same company here, same out-of-pocket to the consumer if this is you, but you've generated $240,000 more in cash value. That's your money you have access to anytime, simply by working with an agent that designs the policy for maximum cash value and at the same time minimizes their upfront compensation. Now the agent still makes money as the years pass, and really for this type of business model, the agent must do a lot of volume just as in terms of pure scale and business. But how I view it is if a consumer is interested in maximum cash value, seeing this type of option up front is critical. So I hope that you found this helpful as far as steps to take as considering what to look for in a high cash value life insurance policy. If you have any questions, please feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.